real estate is often seen as one of the best tools to be able to build wealth.
If you're borrowing funds to buy investment property, then it's a good debt. If you're borrowing the money to go on a vacation, if you're going to buy an expensive car, it's a bad debt.
Fair. If you're ever sort of borrowing money, which has an interest cost associated with it, if you're borrowing it for the purpose of investing it into any type of properties or assets that's going to generate a revenue, you would be able to write off that interest expense.
A lot of individuals think inquiring for a mortgage or a car loan in multiple places bring the credit score down. That's a myth.
So you said certain lenders will increase the payment, which basically means your amortization remains the same and you'll finish it off in certain time.
You'll finish it off on time, which is a painful thing in terms of the cash flow management, but on the long term is the best thing to do.
So provided that there's equity in there, you can still access up to 80% by the workaround.
So let's say, for example, if you're self-employed, they don't look at the income from your notes of assessment and T1s as how traditional the banks look at it. They lend it based on your cash flow of your business.
Hi everyone, welcome to Chat with Chen, and we have a very special guest here today, Varan from iConnect Mortgages. Welcome, Varan, to the show.
Thank you, Chen. Thank you for having me.
Awesome. Varan is obviously a well-established mortgage broker as well as one of the principals at iConnect Mortgages. And he's here talking to us everything about mortgages, secured lending, and just an overall perspective of that. Varan, why don't you introduce a little bit about yourself and we'll start from there.
Sure. As you mentioned, my name is Varan. I'm one of the co-founders from iConnect Mortgages. I've been in financing since 2007, started with TD as a financial advisor, worked at CIBC, went as a regional sales manager and owning the brokerage iConnect for almost 8 years now.
Amazing. So Varan, I know this may sound a little silly to ask, but just obviously in the interest of making sure everybody understands from a financial literacy perspective, what's a mortgage?
Mortgage is a loan that you take from the bank or from institution when you don't have money to pay for the house by cash. Or when you don't have savings to buy it out cash.
Got it. So simply, if the house price is like $1 million, but you only have X amount of dollars to pay towards the down payment, the remaining gets to you as a loan at the end of the day, right?
Yep.
And again, just keeping in the basics of conversation, there's really two different types of mortgages, rates, mortgages and things like that. Or I know you hear fixed rates or variable rates quite a bit, but can you maybe just quickly touch base on those as well?
Sure. So just to touch base on it, there's a lot of individuals, they actually buy property cash as well.
Okay.
So I have gone through a lot of clients, they don't even need a mortgage.
Amazing.
So there's such a thing exists, purchase without no mortgage.
Okay.
So when it's come to secured, it's called secured financing. The reason is secured financing is house is whatever the money you borrow is secured against a home. You can borrow it as a mortgage.
Sure.
And a mortgage has two components. One is a fixed rate and a variable rate.
Okay.
And the other component, you can take it as a line of credit.
Okay.
So the line of credit is a floating rate. So there's no principal payment, it's an interest-only payment.
Got it.
So this product's suitability based on what your need are, what you're looking for.
Got it.
For an example, someone is purchasing a property, they want to sell it in 3 months, they may need a line of credit, not a mortgage.
Got it.
So because mortgages come with the restrictions of prepayment charges and the line of credits are fully open and the interest rate are higher, but it's an interest-only payment. So the product is suitability based on what product they're looking for.
Got it. And fixed rate in simple sense is obviously the rates are locked in for a period of time, I suppose.
Correct.
And then on a variable rate?
Variable rate is the payments are based on, or whatever you pay between the principal and interest is based on what's the prime rate is, Bank of Canada prime rate. So as you've seen over the last 2-3 years, the payment has shot up significantly. So it's putting a lot of people in a very uncomfortable situation financially,
right.
But it's never foreseen for this long. The payments are not stable. And also what happens is some lenders increase the payment when the prime goes up. Like for example, Scotiabank, they increase the monthly payment to keep you float. So your amortization remain the same. Some lenders, they don't increase the payment. So what happens is you're pretty much paying everything towards interest.
Got it.
Or some of them, you don't even cover the interest.
Got it. So So only certain lenders, I guess, increase the payments. It's funny because I think if we did it 2-3 years ago, a lot of people wouldn't have known this. But given the circumstances we are in, everybody would know if their payment. Majority of the people, obviously, payments went up by now. If you're in a more variable rate mortgages, so you said certain lenders will increase the payment, which basically means your amortization remains the same, and you'll finish it off in certain
You finish it
time.
off on time, which is a painful thing in terms of the cash flow management,
Right.
but on the long term is the best thing to do.
Got it. Awesome. And you also mentioned a line of credit. I know people probably throw the terms HELOC or home power line of credit. Is that what we're talking about?
So the generic word for that is a secure line of credit.
Okay.
So each lender has their own name on it. The TD Bank called Home Equity Line of Credit, HPP, and Scotiabank called STEP. So each lender has a different product, but the concept is the same. So it's a line of credit secured against the principal of the home, the value of the property, and you cannot borrow more than 65% of the property value in terms of the line of credit. The maximum you can borrow it 65% of the property value.
Got it. Is that a change? Because I know from my time, from back in the days within the banks, I know it used to be about 80%, if I'm not mistaken. Is that a recent change?
It's about a few years now. I'll say it's more than 5 years. So there's a Bill B20 came in, so they wanted to put the restriction on it. The reason the government doesn't want you to have more than 65% because it's an interest-only payment. So if you borrow 80%, if the market shrink, you are not paying any principal, you're going to be in a tough spot.
Got it.
So that's one of the reasons. So there's a way around it. So if you want to borrow at 80%, you can still take a 15% as a mortgage based on your need.
Fair.
Other 65% as a line of credit. So you can still borrow, but solely as a single product, you cannot borrow more than 65% of the property value.
Got it.
In terms of the line of credit.
Got it. Interesting. So provided that there's equity in there, you can still access up to 80% by the workaround, but the home power or the secured line is only 65%. Perfect. So Varan, talk to me a little bit about, why would somebody choose a fixed rate versus variable rate? What are some typical examples that you see in terms of why someone might prefer a fixed rate versus a variable or a variable versus fixed?
Before 2022 March, everyone chose a variable rate because the rates are lower, and no one ever understood what the consequences of having an increase in the prime rate by 500%.
Right.
And variable rate used to be lower than a fixed rate.
Okay.
And it's a lot of flexibility. So the reason I recommend the variable rate is a flexibility. And if you kind of take away last 2 years, the flexibility is only, if you want to pay off the mortgage, it's only a 3 months interest.
That's a penalty.
There's a prepayment charges. Okay. That's number one. And also you can go from a variable rate to a fixed term.
Okay.
But not from a fixed term to a variable.
Got it.
That's number two. And average size of the mortgage in Canada is 2.3 years.
Okay.
That means either you are refinancing it, or you're pulling the equity out to buy investment property, or you are selling and buying it.
Right.
So let's say, for example, you are your first-time home buyer. You have a mortgage with the TD Bank.
Sure.
At a 5-year fixed.
Yeah.
And you have a really good rate that locked in.
Sure.
Then 2.5 years, 3 years later, you want to purchase another property by selling this. Yeah. You go to TD Bank and they decline you. You will need to go to Scotiabank.
Right.
You may not. So now you need to break the mortgage from TD to go to Scotiabank. That can cost you a lot of prepayment charges to break the mortgage.
Right.
So that's one of the flexibility the variable rate mortgage has, not the fixed rate mortgage has.
Got it.
But it's a time of the year or time when you choose a product.
Right.
But in terms of the fixed rate, the payments are set for the next 5 years. If you are a first-time home buyer, or if you're on a fixed income, if you're a senior, it may be the best option.
Gotcha.
If you know you're going to be in this property for next 5 years.
Got it.
So I think that's why, as a mortgage professional, it really comes down to understanding their clients' short and long-term financial goals to give them the right advice.
Yeah. So it's really understanding the holistic picture before making any type of product recommendation, right?
Yeah.
Then I know there's, by now, a lot of people would know this as well, or would be understanding of this, but there's a difference between what the Bank of Canada overnight rate is versus the prime rate that we typically talk about, right? Usually, I know sometimes people might change it interchangeably without necessarily knowing the two difference. Can you maybe quickly touch on what's the difference between the Bank of Canada's overnight rate, if I'm not mistaken, versus what the prime rate is?
So the Bank of Canada overnight rate, that's the rate the Bank of Canada sets to lend the money. So that's at 5% right now. And the prime rate is set by the banks, depends on what they want to lend the money at, that's at 7%.
Got it.
So there's a big variance. So But when the prime rate Bank of Canada overnight rate comes down, the bank's prime rate comes down as well.
Got it. And just so that everybody knows, obviously we are doing this recording on February 19th or 20th, 2024. So the rates that Varan mentioned obviously is based on that as of today at the end of the day, right? Varan, real estate is often seen as one of the best tools to be able to build wealth. Everybody has different perspectives. People talk about different tools to sort of build it. Can you maybe tell us a little bit about how mortgages sort of becomes the catalyst to be able to help using the power of leveraging to be able to build real wealth per se in general?
I think the mortgages can help you to build the real estate wealth and also regular wealth as well for in terms of your world, financial planning, maybe mutual funds, stocks, and also cash flow as well. That comes down to real estate lending, like a secure lending.
Sure.
So there's a lot of misconception. Mortgage is a bad thing. It depends on what you borrow the money from. If you're borrowing funds to buy investment property, then it's a good debt. Right. If you're borrowing the money to go on a vacation, if you're going to buy an expensive car, it's a bad debt.
Fair.
So I often see a lot of investors, they leverage the properties to the maximum they can within their affordability to purchase another property. So they are not really putting their own funds, even if they do have own funds, they don't use their own funds to expand the real estate portfolio. They're leveraging the existing real estate properties to leverage. And also it has a tax benefit as well. I'm not an accountant, so I cannot really comment on that.
Of course.
So because the amount of money you borrow to invest into another property, that's become a tax write-off as well. And the cost of borrowing was so cheap over the last few years until 2022. So there's a lot of individuals who are borrowing to invest in the stock markets and the mutual funds as well, because you're borrowing at 2% and the returns were much significantly higher. So that's an other avenue that you can use real estate or secure line of credit to build your portfolio as well in terms of the diversifying your portfolio.
Right.
And there are individuals, they were borrowing against a line of credit and lending on a secure lending as well. So that's giving them a cash flow. So it depends on what everyone need and everyone's comfort. And I think the most important thing is risk tolerance.
Right. So I think it's really the importance of understanding this is, as the equity in your house grows, as the values of that, a property grows, it's your ability to be able to sort of use without selling that house or without liquidating that asset, it's your ability to take money out of that by the virtue of the growth within that asset class, and then deploying that, the funds you're retrieving into other asset classes. So now you have multiple sources of, assets that are growing at the end of the day, right? And you mentioned something, and I'm just going to quickly touch on it. I know you put the caveat that, hey, I'm not an accountant, so I can't comment on it too much. But it's really, I think the most important thing for people to understand is if you're ever sort of borrowing money, which has an interest cost associated with it, if you're borrowing it for the purpose of investing it into any type of properties or assets that's going to generate a revenue, you would be able to write off that interest expense. And that goes whether you're investing into, like you said, non-registered portfolio, or whether you're buying a business at the end of the day, whether you're buying another property. Bottom line is you can leverage the power of mortgage and the power of leveraging, reinvest that or deploy that funds into another asset classes, which will help you grow as well, just from an overall portfolio. Varan, what are some of the common mistakes that you see people making, whether, in terms of choosing the different types of products that are available, that can sort of be detrimental from their long-term wealth building perspective?
So one of the more common thing I see is everyone's focused on the rate. So they just go with the non-established lenders and take a 5-year term. They're stuck with it. The values has gone up. They have so much penalty to break the mortgage, so they end up in staying with them, or there's a restriction. They cannot take the line of credit against the lender, so they don't offer the product. So their capacity of reinvesting into any asset class is kind of stuck. That's number one I see. And number two, mistake I see is when someone is purchasing a bigger property. We talked about someone don't take a mortgage.
Right.
So let's say, for example, if someone buy $1 million mortgage, they want to be house free and clear, but they don't understand they can take a small mortgage and invest $200,000 into another property, which is going to have a much appreciation down the road.
Right.
So it's about just focus on different things, not looking outside the box. They just focus on paying the mortgage off. They don't understand how that can work to grow their portfolio or grow their network.
Got it. Awesome. So multiple different perspectives, rates being one thing, looking for the cheapest rate sometimes, which sometimes with certain lenders will come with a whole bunch of conditions that not a lot of people
So they call it
understand.
no-frills mortgage. If you
No
heard
frills
of
mortgage. Is
yeah.
that, okay, that's a term. Perfect. And that comes with a crap ton of conditions that you may not really know until you actually are probably in a position when it's a little too late to understand the caveat to that. So, and then of course purchasing everything cash. That's another thing that you looked at it. Just on the notion of alternative lenders, for example, can you? I know sometimes you hear B lenders, A lenders. Can you maybe just at a very high level just talk to us about some of the different lenders and what some of their purposes are, or where would a particular client may be better fit to certain lender versus another lender?
Yeah, it's a great question. So everyone thinks there's only the bank they deal with, and the banks are the secured. At the end of the day, you are not giving the funds to the bank. The banks are giving funds to you. Right. So you are safe. Right. If you go with the alternate lenders, you are safe because they're actually taking more risk on a client with a bad credit score or a non-traditional income qualifying method.
Right.
So there's three different kind of lenders: banks, institutional lenders such as TD Scotia, then alternate lenders such as Home Trust, Equitable, Community Trust. So what they do is they lend the money on a non-traditional income qualifying.
Okay.
So what that essentially means is they take more risk on a portfolio.
Okay.
Then is a private lenders.
Okay.
So those are the three categories.
Like three major
categories you can fit into.
So perfect. So there's the A lenders, which are typically your big five banks per se. And then there's the B lenders. We spoke about a few things where they are, I'm assuming, a little bit more lenient in the income qualification, or their approach to qualifying.
Their approach is different. So let's say, for example, if you're self-employed, they don't look at the income from your notes of assessment and T1s as how traditional the banks look at it. They lend it based on your cash flow of your business.
Got it.
So cash flow of your business has much higher income to qualify versus what's on the papers with the government.
Got it. And the reason for that is a lot of times business owners, they write off as much expenses as possible, and they don't necessarily take a lot of salary or dividend or salary, I should say, because they don't want to pay a lot of taxes on the personal side of it, which makes perfect sense. And the third class was sort of the private lenders, which, how do they sort of maybe give me one example of a particular use case?
So the private lenders, they don't look at the income, to be honest. They mostly look at, they kind of want to see if the client can afford the payments.
Of course.
But even then in the private, there are institutional private and there's a private, like anyone can lend a mortgage, right?
Got it.
So I usually work with institutional private. They kind of look for the affordability to make sure you can keep up the mortgage payment. Right. And they look at the value of the property. So they lend mostly on the value of the property.
Gotcha. Perfect. And just just to sort of maybe cap this segment of conversation, when we look at sort of the primary banks or primary lenders at this point in time, I hear the word stress test kind of being used. Can you maybe elaborate on that a little bit? Just what are they actually looking for when we say stress test?
Okay, so that's a great question. So until 2019, sorry, not 2019, 2019, you can qualify, if you take a 5-year fix, you can actually qualify the actual rate. So now, any product that you choose, whatever the contract rate plus 2%.
Okay.
So since rates has gone up significantly until 2022, the benchmark rate was 5.24. Sure. So we are qualifying everyone at 5.24.
Okay.
Right now, if someone is taking a 5-year fix, like let's say 6%, the same client is qualifying at 8%.
Got it.
So that's really reduced the buying power of the clients, what they can qualify.
Got it. So really, from a stress test perspective, whatever the rate for the product plus 2% has to be used to qualify for it. And I know you guys look at ratios and all of that stuff, but ultimately that reduces the ability for someone to purchase a larger home or a home with a larger value per se.
That's also kind of the reason why we are seeting a little bit of a price drop on the real estate as well.
Got it.
Because affordability is an issue.
Got it. Perfect. So let's segue a little bit into, I know you touched on this, a little bit before, but debt consolidation. I know that's a huge thing because I know even with the work that I do, with the work that you do, ultimately, cash flow becomes the king of everything at the end of the day, right? Yeah. So when we say debt consolidation, what does that actually mean to you? And then how do you what are some real life examples of you helping people, I mean, just at a very general level, to help with their cash flow?
So the cash flow is the king. So a lot of people, they have multiple debts in a multiple different categories. So it could be a line of credit, it could be a car loan, it could be a credit card debts, or it could be a second mortgage. So the prime thing I hear is, oh, I have a Capital One credit card. I don't have any interest payment on it. I'm like, yeah, that's only for 6 months or 12 months. What happened after that's at 20%.
Right.
So my advice piece comes in is look at the overall debt scenarios. Mortgage, line of credit, credit cards, car loans, or like secure loans, second mortgage, whatever it is. My job is this is the interest that you are paying overall, even though you can have a 2% on a mortgage, but your overall carrying cost is probably 9%.
Got it.
If I can consolidate that into a 5% or 6%, you are saving interest, you are saving cash flow, and you have a breathing space. So you can do protection. Like one of the advice I give is people having a problem keeping up their life insurance. They can't keep up the payments because they don't have a cash flow. Right. So I know the amount of debts they have,
right.
but when you kind of clean that up, they have a breathing space.
Right. So it's really consolidating, anything that has a high interest rate, and you're paying high interest, one thing, but also your cash flow is obviously being significantly diminished.
Yeah.
And if you can sort of put everything together, sure, you may have a smaller mortgage or a mortgage with a lower interest rate here now, but with all the other debts somebody might have, obviously, I look at some of the stats, and it's like 2 out of 5 Canadians, their biggest concern now is obviously debts and everything else. And if you can consolidate that with maybe the mortgage or any type of secured lending type product, you're able to significantly free up their cash flow so they can actually allocate those towards things that matters, whether it be children's education, whether it be retirement planning, whether it be investing towards other investment goals or insurance planning like you mentioned. Bottom line is, how do you free that up so you can actually invest it towards obviously something else?
For example, if you have a $10,000 credit card, the bank's required minimum payment is 3% of the outstanding balance. That's $300.
Right.
For $300, you can borrow almost $50,000 on a mortgage, $50,000 plus.
Fair.
So you know where I'm going with this.
Of course.
It kind of makes sense.
Yeah.
And don't just stick to the mortgage rate only.
Right.
Because a lot of people perception that I have 2% on the mortgage, 3% on the mortgage.
Right.
But what is the overall debt? You can have a private mortgage at 15%.
Sure.
And you're just not paying the interest only. You're not making a head with it.
Right.
So it's very, very important to understand overall cost of borrowing and overall cash flow.
Perfect. And Varan, just something that just came to my mind, amortizations right now, what is sort of the norm? I know we hear 25, 30 years. Okay.
So there's two kind of mortgages. One is a conventional mortgages. That's where someone has a 20% down payment or 20% equity.
Okay.
They can have a 30-year amortization.
Okay.
And anyone who purchases a property with less than 25%, less than 20%, the amortization is 25 years.
25 years.
That's the insured mortgages.
Got it. And I know there's, so if you have 20% down payment, you can go up to 30 years. Anything less than 20% has to be 25 years. Okay. And I know within that, for example, even some people say you can buy with 5% down. Is there any price range that people, like if they stay within certain thresholds, then their down payment is lower, for example, or it has to be 20% after a certain threshold of pricing?
So CMHC or insurers only approve the mortgages up to $1 million purchase price. So your purchase price cannot be more than $1 million for the mortgage to be insured and purchased with less than 20% down.
Got it.
So first 500,000 is a minimum 5% down.
Okay.
And anything above 500,000, you need to have a 10% down.
Gotcha.
So for example, if someone is buying it for $1 million or like a 999, first 500,000 is $25,000, and the second 500,000 is 10%. So that's 50,000. So you need to have a minimum of $75,000 down payment.
Got it.
But you need to have a really strong income to qualify. Because they have a very, very stringent guidelines, and there's no exceptions. You need to be very strong on income. So there's a lot of first-time home buyers probably can fit into that with a very high-paying jobs, have a very limited down payment. That is an option.
Okay, so contrary to the popular belief that you have to have 20% down to buy a home, obviously we just established the fact that technically up to 999, we might be able to get away with the 75,000
minimum down payment,
like a very minimum 75K down payment.
I think it's worth to be like a 6.5% or something.
Got it.
Yeah.
But that being said, the caveat is you got to be able to qualify with the income because you need to be able to support a much larger mortgage.
Yeah.
So you obviously have to have a pretty large income to be able to support.
And also that cannot be investment property. That has to be a principal home.
Gotcha. So obviously various conditions apply, for those kind of mortgages. Varan, let's talk about credit scores. I know that's pretty important for things like mortgages, but it's also important for anything else. I mean, in Canada, I say a couple of things which are important, credit score being one, which is obviously super important for anything else. How does it affect borrowing? What are some ways where people can improve their credit score? What are some general guidelines to keep in mind?
So the banks has guidelines. So if you want to qualify for a mortgage with the Schedule 1 banks, you need to have a very strong credit score, minimum of 680. So some of them are okay up to 640, but the cutoff is 620. So anything below 620, they don't lend on it.
Gotcha.
So to keep up the credit score high, make sure your payments are on time. That's the most important thing. You don't need to pay the full balance, at least make the minimum payment on time.
Okay.
A lot of individuals think inquiring for a mortgage or a car loan in multiple places bring the credit score down. That's a perception. It doesn't, because the algorithm is set up in a way that you are allowed to go and shop for the best product possible. So that doesn't bring the credit score down.
Got it.
What brings the credit score down is if you're carrying 50%, more than 50% of the limit, that's bring the credit score down.
Got it.
So for example, you can have a $10,000 credit card, have a $9,000 balance or $9,500 balance. That's going to bring your credit score lower versus you go and apply for a car loan in 2 different places to make sure you get the best rate.
Interesting, because I actually followed one of these myths, or I actually thought these myths were actually real, which was like, if the credit score gets pulled in multiple places, I thought the rates or your scores do come up. But I think the one thing that I've definitely heard is try to keep the balance obviously below 50%, and then make sure the payments are done on time, at the end of the day, right? Yeah. Perfect. Awesome. And last but not least, within this sort of segments, loans versus line of credits versus secured line of credits. We've established secured line of credit is obviously something that's secured by a property, in
Property,
this
or
case.
some the banks, they do investments as well.
Perfect.
I think in your world they do investments.
Exactly. But what's the difference between loans and line of credits? Which is easier to get? Which is harder to get? What's the benefit versus on one versus the other, and what the rates, how do they look different?
Yeah, so the loans are the term reducing. Loans are very similar to the mortgages.
Okay.
So you take a $30,000 loan, a $50,000 loan, it says a 5-year period. So you keep paying it down. So the principal come down and the interest goes off and you're paying it off.
Perfect.
The line of credit is an interest only payment.
Gotcha.
So it's best for the cash flow, but you are not getting rid of the payment unless if you're making a lump sum payment.
Got it.
So if you want to have a set plan where how long you want to take to pay it off, I would say the loan will be the best option compared to line of credit.
Got it. So loans is more so once you keep paying the payment, you're paying off the principal. You don't necessarily get access to that cash flow.
It's not a revolving. So I think the biggest difference between the mortgage and a secure line of credit, or an unsecured loan and unsecured line of credit is a revolving debt, and a loan is not a revolving debt.
Perfect.
So in terms of easy to get qualified, loans are get easy to qualify. When the bank underwrite it, they know once it's paid off, the client will not have access to that. The underwriting is more hard on the line of credit because you can pay it down and you can keep borrowing. It's a lifeline.
Gotcha. And does the interest rate a little bit lower on a loan versus a line of credit?
It's about the same.
Okay.
I don't think there's a significant difference.
Okay, and it really depends on a case by case.
Case by case credit score does make a big impact as well.